Hello, welcome to another installment of our webinar series, this one on Social Security basics. I'm Tony Marlette Jr., advisor at Brookside Tax and Financial. If you want to check us out online, our website, our YouTube page, our Facebook page as well, you can do so via the links on your screen. Some things you'll find on our website include access to webinars that we've done in the past that you can register for on a wide range of topics, staff bios, and a little bit of background on our company. Our YouTube channel, you'll find market updates from the past that we do every month and podcasts from the past that we do semi-monthly. And then on our Facebook page, we tend to keep that a little bit lighter with contests, trivia, pictures of staff, pets, babies, etc. So one disclaimer that I'll put out there as well, anything we talk about today is not intended to be individual advice. So when we talk about such a topic like Social Security, it's going to be an overview. For any advice that pertains directly to your financial situation, you want to refer to your financial professional, your tax professional. Of course, if you're a client of ours, that's all in the same building. So if we take a look at Social Security and exactly what it is, by definition, there's benefits paid to a retired or disabled worker or a surviving spouse or family member based on eligibility. Remember, you earn 4 Social Security credits per year, 1 per quarter, based on time worked. Social Security has really been around since 1935. A common misnomer, though, is that it was never really intended to be somebody's sole source of retirement income. So to clarify, sometimes people, will say that originally Social Security was enough for people to live on. That's not necessarily true. Social Security was always intended to be a supplement for what people can live on in retirement. And that's no more true ever than it is right now, certainly. Pensions are starting to go by the wayside. We've talked about that before. People are really utilizing that 3-legged retirement stool where we talk about pension payments, Social Security payments, and then payments from qualified or non-qualified assets like IRAs and brokerage accounts. So when it did start in 1935 under the Franklin Roosevelt administration, we see a definition here, men and women too old and infirm to work. I'm not going to read the whole definition, but it's a workable and working method of meeting urgent needs. So it was not intended to be a full source of retirement income. Interestingly, when the first benefits were paid out, they were all paid out in a lump sum. Monthly payments with Social Security did not actually get started until 1942. The first Social Security payment that ever went out was for around $58. $58 was the first Social Security payment that ever went out back in the 1930s. So everyone is aware of the Social Security shortfalls at this point, but these were also acknowledged as far back as the 1940s. And as you can see on the screen, the Social Security Administration posts this warning on their website, stating that essentially changes to funding will need to be made to fully fund benefits for those filing after 2035. So it's not saying that it's going to run out or there's going to be no benefits available. It's saying that it will not be fully funded unless certain changes are made by that time. So if we take a look, we're not going to go too much into the calculation. Everybody's going to have their own Social Security benefit calculated, but essentially the formula breaks down like this. If your income is what's considered high, or if it's considered low, and obviously those numbers are going to change, you either get 20% of your average or 50% of your average, and your benefits are taxed according to your total income. So it's not necessarily taxed on what your Social Security benefit is, it's taxed as your total income. So there's a concept known as full retirement age, or FRA. Essentially, a full retirement age is kind of just a barometer. It's a marker that says these are your benefits relative to your full retirement age. Now, your FRA is going to be different depending on when you were born. It's not necessarily a maximum benefit either. So, for example, if you claim benefits, anyone born after 1960, their FRA is age 67, but benefits will continue to accrue until age 70. If you're working after you claim benefits, you can actually increase your Social Security benefit, but you want to make sure you keep your income down to around 18,000, well, it's 21,000 now, $21,240. Otherwise, you get a reduction. It's a $1 reduction for every $2 earned. So if you're collecting Social Security prior to your full retirement age, and you earn more, these are updated numbers, but they change just about every year. 21,240. You make more than that, and you collect Social Security before your full retirement age, you get a benefit that's going to be reduced $1 for every $2 you earn. And if you make more than 56,000, you're going to get a $1 reduction for every $3 you earn. So again, it's important to keep in mind your full retirement age. So you can see what the different full retirement ages are depending on when you were born. Again, it's not not a maximum benefit. Benefits do stop accruing at 70. So when you take that benefit, if you defer till 70, there's no point in deferring any further past 70 because your benefit does not increase. When we meet with clients, we talk about a concept known as a break-even point. And a break-even point is pretty simple. It essentially looks at what's more worth it for you, collecting earlier but getting a smaller paycheck for a longer period of time, or collecting later, getting a larger paycheck for a shorter amount of time. So obviously, when you collect Social Security, especially if you go before your full retirement age, you're going to get a reduction. If you wait till full retirement age or later, you're going to get more, obviously. Most people understand that. The break-even point tells you, based on life expectancy, what your best bet is. It does not take into consideration anything like your outside assets, your pension, any other working income. It simply says, this is how you can maximize Social Security. We'll talk a little bit more about that later. Most claims, 6 out of every 10 for Social Security, come in before full retirement age. Early benefits claimed at that point can shrink by about 30% if you were born after 1962. So essentially, the longer you wait, the more benefit you collect. We'll go over how to maximize that in a minute. There's a couple of concepts that can reduce your benefit even further. If you're a government employee, we see this probably the most frequently, but there's a concept known as the windfall elimination provision. Essentially, it reduces Social Security benefits for any employee who does not have FICA taxes or Social Security taxes withheld from their salary. This came about in 1983, and it essentially bars people from double dipping, right? So if you're collecting a government pension and you did not have Social Security taken out, you do not get to collect your full Social Security benefit. Most of the time, people have work that they have had Social Security benefits taken out before they get to such a position where, say, you had none. So you still get a partial Social Security benefit. The windfall elimination provision does not zero out anybody's Social Security benefit. It reduces it because you're already getting a government pension. If you're paying into FERS, or Federal Employee Retirement System, which is a benefit system that we handle here at Brookside, your benefits are not affected. If you have 30 years of substantial earnings, the windfall election or the windfall elimination provision does not apply to you either. Again, for anything on your personal situation, talk to your tax advisor or your financial professional. Similar to the windfall elimination provision is something known as the government pension offset. Now, this applies to spouses and widows' benefits only, but it functions in kind of the same way as the windfall elimination provision does. And what the government pension offset, or the GPO, tells us is if you receive a retirement or disability pension check from a federal, state, or local government based on your own work and you did not pay Social Security taxes, when you pass away, the other spouse, if they're covered by a government pension, does not receive the full Social Security benefit of the original worker. So, for example, if spouse A and spouse B, spouse A was covered by Social Security, spouse B has a government pension. Spouse A passes away, and say spouse A passed along a $1,000 a month Social Security benefit to spouse B. Spouse B has a $2,000 a month government pension. So spouse B can still collect their full government pension, but their Social Security pension is going to be cut by 2/3, or about $1,200, since that's their government pension. So in reality, they would receive about $800 from Social Security, which is 1/3 of their government pension. So it's an offset number. You still get to collect a Social Security benefit, but it's offset by 2/3 of what your government pension is. The government pension does not get cut. They cut 2/3 of your government pension off of your Social Security benefit. And again, that's for spouse and widow benefits only. So many people know Social Security has disability benefits. This is paid to a worker who has qualified with enough credits and time worked that can no longer do their job. So common conditions exist that are all considered disabling, but any condition should be pursued. Just as kind of a side note, a lot of people are aware, most people get rejected by Social Security disability their first time. They would actually tell you to continue to apply as well. And each time you stand a better chance of getting approved. If the impairment that you have is on the serious side, you don't have to prove anything. You're assumed to be totally disabled. Sometimes a worker is considered to be disabled if the impairment is expected to last at least 1 year. And they do look at a thing called transferable skills. Transferable skills essentially means you're not considered to be disabled if you can do less demanding work. Now, the good part here, it's not on you to prove that. It's on Social Security disability to prove. So if they can prove that you can do less challenging work, then you can do less challenging work. And that's how they evaluate your disability process. Any dependent benefits for Social Security include a spouse age 62 and up, and that includes a divorced spouse as well. Any unmarried children disabled before 22, unmarried children up to age 19 and in high school, or any unmarried children up until 18. They will pay Social Security a one-time death benefit of $255 to a spouse or a child if there is no spouse. Any benefit post Social Security or post death received from Social Security does need to be returned and paid back to the administration. We see that sometimes when we're doing taxes. If somebody brings in a late spouse's Social Security statement, it'll say on there that they received X amount of benefits for the year, but they returned Y, and it nets out at Z. So any spouse age 60 or older can receive benefits, and then they can even take their benefit as early as age 62 if it's more advantageous. So if you're, say, 60 years old, your spouse passes away, and they had a Social Security benefit, you can take your beneficiary benefit, and then at 62, if it's more advantageous for you, you can claim your benefit as early as 62. You don't have to do it at 62, but you can claim your benefit at 62 or later if it's more advantageous. Same thing for a divorced spouse, as long as the marriage lasted at least 10 years. And then survivor benefits can be taken at any age if the surviving spouse is taking care of a dependent under the age of 16. So we talked before about maximizing Social Security and implementing this into a plan. So how do you do this? Everybody has what's known as a PIA with Social Security, a primary insurance amount. This is the amount that all your benefits are based on. So when you come to us for your financial plan, we look at all your statements of all your other accounts. We look at your income, your expenses, and your PIA. When you bring us your PIA, we can calculate your benefit based off of that number, and you can access it by visiting ssa.gov, myssa.gov, and creating a login ID and a password. It used to be where I think once a year they would send you a Social Security estimate. They may still do that, but I think now a lot of it is online where you log into the account, they show you what your benefit is, you can bring that to us, and we base the calculations off of that. And what we do with this report is we talked about the break-even point before. We look at how to best maximize your Social Security. This report that we are going to run for you only talks about how to maximize your Social Security benefit. The report does not take into consideration any other assets that you have. So I tell people all the time, when we run this Social Security report, it's how you and your family, you and your spouse, can maximize the benefits that you get from Social Security. If it says that each one of you can wait till 68 and one of you can wait till 70, but you're 62 and you don't think you can work another 8 to 10 years, then that's fine. You have to adjust. So then you start taking the income earlier, and you may or may not have the assets to live off of. You do what's in your best interest for your personal situation. All our report is going to say is this is how to best maximize Social Security. When we incorporate that with the financial plan based on your other assets, your income, your goals, your strategy, and your time frame, that's when it works the best. So some common things that we look at in here are going to be taxation. We talked before about the percentage of your Social Security benefit that is subject to tax, and it's based on your total income. So 50% of your Social Security benefit is taxable if you're married and you file a joint return and your income is between $32,000 and $44,000. If you're filing a single return, it's between $25,000 and $34,000. So again, those numbers pertain to 50% tax, up to 50% of your benefit with Social Security being taxable. 85% of your benefit is taxable if you're married filing jointly and your income is $44,000 or more. And if you're single, 34,000 or more, for 85% of your Social Security benefit to be taxable. Not taxed at 85%, not taxed at 50%. It's 85% of your Social Security benefit or 50% of your Social Security benefit being subject to taxes in those income ranges. So we oftentimes take a look at things like Medicare. You go onto Social Security, ironically, onto the Social Security website to claim Medicare. We could do a whole separate seminar on Medicare, and we do. And we talk about how that affects your benefit and how working a little bit longer can affect Medicare benefits. That's another topic for probably another day. When you come in and request a consultation with us, if you reference this video, you can pick up a copy of one of our books on retirement planning and estate planning as well at no cost to you. If you book a strategy session with us within the next 48 hours, your consultation with us will also be available at no cost. You can give us a call at the number on the screen. Obviously, you can visit us on our website as well. And I do encourage you to look at our YouTube channel and our Facebook page too. Our YouTube channel, like I said, has some different videos from the past. Website has webinars that we've done in the past. Facebook page, some different content as well. Do you have questions on this? Give us a call. Anything specific, I'll mention it again, should be run by your financial professional or your tax professional as well. If you work with us, that's all in the same place like we mentioned before. Thank you for working with us, and we look forward to continuing to work with you.